please welcome your presenter, Mr. Brian Perry, CFP, CFA. Brian, are you with me?
I feel like I'm not in the camera. There we go. There's my beautiful face. How are you?
Very well. Good to see you.
You too. You too. Welcome, everybody. It's good to be here. Looks like we got a pretty good crowd today. We're going to cover through a lot of things today. And what we wanted to do was wanted to make this as interactive as possible, right? So a lot of you I've met before, those that I haven't, and, hopefully we'll have you guys come in person at some point. I really enjoy having it more live, a little more interaction and stuff like that. Feels a little bit remote here doing it over the camera, but this is the world we live in. Hopefully there's vaccines. They'll start getting distributed. For those of you in California, what, Andy, we're off the watch list now or off the shutdown or something?
And I think that just happened yesterday. Or,
yeah.
Is that right?
Not sure it's
really hard to keep track anymore. So
I know. Supposedly you can get a haircut now, right? So
there you go.
But yeah, so what we did today is I want to go over kind of what happened last quarter, last year, and we'll talk a little bit about what may be on the horizon going forward. Really broke it up into a question and answer. So what I did was obviously I meet with a lot of clients. All of you meet with your advisor. I meet with all the advisors. So collected a lot of the questions, the common things that are coming up in conversation, things that are probably on some of your minds, and wanted to put this down in a question and answer format. So what we'll do is we'll dive in there, and then as we go along, please let Andy know, and Andy will weigh in and ask me some questions. And so with that, let's start some slides here. And what I want to do is go through, starting with, we're going to go back to the beginning here. I think starting at the beginning is usually a good idea. And my first question really is kind of what the heck is going on, right? So we had a crazy year. We had, we had COVID. How many people, if we were having this conversation at the beginning of last year, would have thought that the number one story was a global pandemic and shutdown of the economy, right? Probably not too many. So we had a pandemic. We also had some of the biggest political turmoil in history, social unrest, a really contentious election. And then this year kind of gets started a little bit crazy too, with some goings-ons at the Capitol and stuff like that. Fortunately, we've had a peaceful transition of power in Washington. But what's going on? What's the outlook, right? And so I think it all begins and really ends with COVID and what's going on with COVID. And when we look at COVID right now, it's really surged again. As you all know, we had the peak in the spring, and then things really leveled off. And I think some of that was social restrictions. When people couldn't leave the house, they couldn't spread COVID, right? Some of it was summer. The disease maybe isn't as virulent in hot weather, although I don't know if that's a scientific fact, but it certainly always seems like people tend to get sick more in winter than in the summer. There was also time there where more people are outside doing things, and so there's not as much transmission, not as much gathering in the home. And then we saw this resurgence into the fall and into the winter, which led to renewed shutdowns. Places like the UK completely shutting down, renewed in some European countries, curfews, shutdowns across America, and certainly in California where we're located. And in fact, renewed shutdowns where shelter in place wasn't as strong as it had been back in the spring, but a lot of activities were restricted. Andy and I at the beginning there joking about getting haircuts or going to restaurants. A lot of that stuff got shut down again, headed into the holidays, just reopening now as capacity comes back in intensive care units and stuff like that. So, you look at it and it's a second kind of peak there, a higher peak than the last, and has now started to decline a little bit, cases and fatalities, and we'll see. The good news from a COVID perspective, obviously, there's vaccines now. They're not being distributed as quickly as people would like, but they are becoming available. The downside is, again, first of all, they're not being distributed as quickly as people might have expected. The second thing is you hear about these new strains out there, and I'm not a biologist, I'm not a doctor, so I don't know what the impact will be, but you do hear about new strains of COVID that potentially are more contagious. So we'll have to keep an eye on that. Because when we shift to investments and the economy, really the impact of COVID has been restrictions on what people can do. Right? And so this measures high frequency economic activity. So this is stuff like taking out a mortgage or credit card transactions or hotel occupancy, travel, right? So these are things that you can measure almost in real time without much of a lag. And you can see the precipitous drop here in March, where in some cases, dining dropped by 100%. Right? Imagine that as a business. You model out worst case scenarios down 10%, 20%. There's a recession, this and that. I don't think too many people ever anticipate a 100% decline in their business caused by something beyond their control. And then you can see a pretty sharp snapback in most of this stuff, a rebound, but not a full recovery in a lot of cases. And that's really a trend throughout the economy, is a rebound, but not a complete recovery. This here is unemployment, the dark blue line, and you can see that it spiked here to almost 15% back in April. That was the highest level on record and quite a bit higher even than the financial crisis. but also an incredibly sharp recovery to now where it's right around 6.5%, 7%. So still higher unemployment than we've grown used to, and certainly higher than anybody wants, but it has recovered. Again, continuing that theme of an economic recovery in progress, but we're not back to where we started. Earlier in the COVID experience, there was a lot of talk around, will we have, what kind of a recovery will we have, what kind of experience? And there was talk about a V or a U. And so, if I go to this board here and just do a little bit of drawing, I'm going to there was talk, right? Will we have a U-shaped recovery? And that means that we decline and then gradually bottom out and then come back up. Some other people talked about a V-shaped recovery, right? Maybe we'll have a sharp drop but a sharp rebound. The one that I thought made the most sense, honestly, was more of a check mark, right? So we had the sharp economic drop followed by a really sharp rebound and then a stagnation, right? And I think that for a lot of people, that's the experience that we're having right now, is this check mark recovery where there was such a sharp contraction because people couldn't leave their homes, and then a sharp recovery as some of those restrictions were lifted, but we're not back to normal. And now it's the process of healing the economy. Government stimulus has certainly helped. The Federal Reserve and easy monetary policy has helped. We'll see what we see in what happens in the way of additional stimulus. But it's going to be a process. There's a lot of long-term unemployed people who their balance sheets, their personal balance sheets are significantly damaged. Maybe they've drawn down their savings or run up debt. It takes a while to recover for that for a lot of people. And ultimately, it's important to remember that the consumer represents almost 70% of economic activity. So government spending is really important, businesses, et cetera. But the biggest source of economic activity in the United States is the consumer at about 68%. The government, when they come in with some of these stimulus packages, they're trying to soak up some of the lost demand from the consumer. They can do that for a while, but they can't do it indefinitely. Ultimately, it's the consumer that will drive the economy. From there, just to flash forward, I would want to comment on the election, because obviously we had an election and now we have the Democratic administration in office. And a lot of people had really strong opinions about the election. I'm not here to take a view one way or another on, what party's better or worse for the economy or financial markets. But I do always like to just fall back on the data, right? Emotions run high, but what does the data say? And this chart here looks at annualized returns of the S&P 500, so of the broad, large cap U.S. stock market during presidential terms, reds, Republican, blues, Democrat. And anything to the right-hand side of the bar is a positive return during that president. And what you see is almost every president has had positive returns, whether Democrat or Republican. A lot of that has to do with the upward progress of markets over time. But I bring that up, again, just falling back on facts and not making any sort of judgment on how good or bad of a president Joe Biden is likely to be. But historically, most presidents have seen the stock market rise while they're in office. So then the question is, all right, well, the economy hasn't been great, so why have markets been going higher? And this is a really long-term chart that we're looking at. This actually goes from the 1890s all the way through recent times. And what you see is that over time, markets go higher. And sometimes that's simply the answer to why is the market doing well if X, Y, Z is happening. It's that markets go higher over time. In fact, if you think about it, then so on the Your Money, Your Wealth show one time, Jonathan Clements, a longtime reporter for the Wall Street Journal, came on. And he said that if you believe that life is better today than it was 100 years ago, and I think most people would agree that for a lot of folks it is, whether it's because of vaccines, travel, technology, whatever, life gets better. It's because most of the time a company made some good or service that improved people's lives. They made a drug that cured smallpox or whatever, or they made a jet that allowed people to fly around the world, the iPhone, right? So if you think that people are going to continue to see their standard of living improve, it's probably going to be because some company is going to make a good or service that people like or that improves their lives. If that's the case, those companies are going to make profits, which are going to flow through to shareholders, which is going to lift the stock market. So bottom line is, if you're optimistic on human progress, then you should be optimistic on the stock market. And that doesn't tell you what's going to happen next quarter or tomorrow or 2 years from now or what stock to buy, but it does say that there's this broad momentum, this broad rising tide lifting most securities across time. The other thing I want to point out is that volatility and stock market sell-offs is not unusual. And so you look at this chart here going back to the late 90s, mid 90s, right? And what you see is these pullbacks. 1998, that was when the Russian long-term capital management, this big hedge fund, went under, and Russia defaulted on their debt, and there was turmoil in Asia and stuff like that, sharp pullback. Then you see 2002, the early 2000s, the tech.com bust, and then the great financial crisis and a bunch of other pullbacks. So you see volatility is not unusual despite this upward progress, which I think is an important reminder because we've had a really good run in the stock market recently, and I'll get to that in a moment. But it's important to remember that we're not necessarily out of the woods. Volatility is not gone forever. We will see renewed sell-offs at some point, followed by recoveries. The other thing is, I think is instructive is you look at this chart over in here from basically the late 90s through, I don't know, the early 2010s. And you see this is the S&P 500 went nowhere, right? And again, we talk a lot, and we'll talk a little more about why we diversify among big companies, small companies, international bonds, stocks. This is the reason why. We've talked about it in the past. They talk about a lost decade. It was actually more than a lost decade. From the late 90s here through the early 2010s, if you were just invested in the S&P 500, you wouldn't have made any money, right? And for a lot of people that are trying to distribute income to themselves in retirement or trying to save for retirement, that can be really devastating. So that diversification allows you to own. There were most other asset classes during that period that actually did pretty well. It was just large U.S. companies for the most part that struggled. Shifting to the more recent, right? So the fourth quarter, if we look at performance, basically everything did well, right? And so starting here, the best performing asset class in the fourth quarter of 2020, Russell 2000 Value Index. So those small company value stocks up 33%, followed by small company stocks, the Russell 2000 up 31%. And so we talk all the time about small and value premiums and the idea that over time, these tend to do better. And in some cases, it was a painful ride for a couple of years where larger companies did better than small and growth companies did better than value. And that happens periodically throughout financial markets. It's not a guarantee, but over time, we do see smaller, the data proves or shows that smaller, more value-oriented companies outperform larger, more growth-oriented companies. And we saw that come to fruition in Q4. Doesn't say anything about what's going to happen going forward. We have no idea. But we do know that over time, there's logic behind those premiums, and the data bears it out as well. You can see that even the lesser performing asset classes like bonds still posted positive returns. The S&P 500 last quarter was actually the worst performer, up about 12%, but still did pretty well there. You know, if you get double digits on a stock portfolio in a quarter, that's a pretty good return. So good fourth quarter for markets. Looking more specifically here, U.S. stocks here up about 15% last quarter. This is measured by the Russell 3000. So all U.S. stocks. International companies, so out of Europe, Australia, Canada, Japan, up about 16%. So strong performance for international companies. And then emerging markets really strong, up almost 20%. So emerging markets were one of the best performers last quarter. So too were small companies. A little bit of a reversal from what we saw the first half of the year. If we take that over a little bit longer lens and look at what's been going on, you can see that the U.S. stock market up about 21% in the last 12 months. International developed stocks only up about 7.5%. Emerging market stocks have done well, up about 18%. So emerging market stocks did really well in the last 12 months. So too did the U.S. stock market. International developed stocks did really well. I mean, 7.5% is not something to kind of look badly at. That's a good year, but not as well as other kinds of markets. And then you look longer term over 10 years, you can see, and 5 years, you can see again, emerging markets have done pretty well. International companies haven't done as well. And we'll talk a little bit more about that in a bit. All right. So let's talk about how some of these sub-asset classes are doing. How are small companies and value companies doing? How are international companies doing? Some of these tilts that we put in portfolios because we think that over time they provide you with additional diversification and also potentially higher returns. Again, if you look last quarter, small value, small company, and small growth were the three best performers up here with the blue charts, followed by large value and then large companies and large growth. So again, we see that last quarter, those tilts in the portfolio towards small and value helped. But here, if you look over a year, they didn't do as well. Small companies actually did pretty good. So if you look at large companies in the last year, up about 21%, small companies up about 20%. So basically same. But value in the last year has underperformed growth. So if you look at, let's say, small value up 4 versus small growth up 34, and then again, in the large cap space, growth outperformed value pretty significantly. So in the last 12 months, basically a tale of two cities where the first half of 2020 was a period where large growth companies did the best. The second half of the year transitioned into an environment where smaller, more value-oriented securities did better. And that's not unusual for these cycles to rotate. One thing I want to focus on here is sectors, right? Because we spend a lot of time and the media spends a lot of time talking about big versus small and the S&P versus international stocks and stuff like that. But at the end of the day, it's not a stock market, it's a market of stocks. So the stock market is really a collection of thousands of stocks around the world, probably about 15,000 stocks within the US and abroad, right? And then these are formed into sectors, different kinds of companies, maybe consumer-facing companies, technology companies, construction companies, et cetera. And a lot of times the performance of different sectors is what actually drives indexes. And here's what I mean by that. If you look at the last 12 months and look at what has done well, you can see that online retail is up almost 70%, right? That's not a surprise. If you can't leave the house to go shopping, you need to still get stuff, so you buy it online. Those companies have done well. Second best performing is information technology, so tech, up 44%. And then home improvement, if you're stuck in your house, you might as well make it look nice, right? Up, 28%, right? Then you look what hasn't done as well. Well, energy, airlines, right? Retail REITs, retail reinvestment, retail trusts, hotels, cruise lines, right? Things that you can't do when there's a pandemic and you can't leave your house. They didn't do as well. The reason I'm pointing that out is when you look at the composition of the indexes. So this is, in gray is large companies and in green is small companies. And when you look at the breakdown in the big company universe, almost 30%, 27.6% of it is in IT, in tech. When you look at the small companies, only about 14% is in tech, right? So when tech's doing good, that's going to help large companies outperform small companies, right? And so these sector breakdowns can impact the indexes. Right? Same thing with value versus growth. There's a lot of numbers on this slide, so please don't try to memorize everyone. But when you look at this, it's the S&P weighting for a sector, followed by the growth index and then the value index. And again, I want to point out over here, this column for technology. You can see that 45% of the Russell Growth Index, so of the growth stocks index, is tech, only 10% of the value. So again, when tech does well, it's going to lead to growth doing better. The reason I'm pointing that out is that there are times when one sector does better and times when the other does better, right? In the 2000s, it was mostly financials and energy. In the last 5 years, it's been tech. Last quarter, we saw it broaden out a little bit more to where a number of sectors were doing better. So again, broad diversification, the idea being that at different times, different sectors are going to do well. But I think it's important just to have a sense of what's going on under the hood of some of these indexes. Similar vein, right? We globally diversify portfolios. We fundamentally believe two things. First of all, there are periods in which international stocks do better than the US, and there are periods when US stocks do better than international, so we think it makes sense to own both. The second thing is that we don't believe that the United States has a monopoly on great companies. Nestle, Toyota, Alibaba, there are lots of great companies abroad that we think it makes sense to own and to capture by buying into international markets to a greater or lesser degree. Now, we still want more of the portfolio in the US because that's where you all live, work, consume your dollars, spend most of your time, but we do want that international global diversification. When we look at last quarter, again, most of the international countries did pretty well. Mostly everything, again, did pretty well. You look, the best performing developed market down here in the left-hand column was Austria, followed by Spain, Norway, Australia, Israel. So international markets did very well. You look at the US, almost down here towards the bottom, about 15%. So international markets did pretty well on the developed front. Then you look at the emerging markets. Colombia was the best performing, up 47%. But almost every country, or most of them, was up double digits. So really strong performance across the board, except for poor Egypt. Egypt didn't do so well last quarter, down 2.5%. Some of that is driven by currency. And so when we talk about global diversification, a portion of that is how the company is doing, how the market is doing. Some of it is currency, because as a US investor, if you want to buy international stocks, you basically take your dollars, and let's say you're buying Nestle. You take your US dollars, you turn them into Swiss francs to go buy Nestle stock. Then when you want to bring that home, you sell the Nestle stock, convert those Swiss francs into US dollars again. And so what that means is that when the dollar appreciates, when it strengthens, that hurts the performance of international stocks for a US-based investor, because when you convert back to US dollars, you get less of them. Conversely, when the US dollar is weak, when you come back to the US, you get more US dollars, so it's a positive for international investors based in the US. And so what you see last quarter is that most currencies did well against the dollar. You can see that, everything from Norway and Sweden through New Zealand and Australia down to the euros, the other big currency, up 4%, and then emerging market currency. So most currencies provided a tailwind to international stocks. A little bit of a difference from the last several years where we were in a cycle where the dollar was mostly pretty strong. We'll see what happens. I will say that one of the things that's been driving the dollar has been the interest rate differential, where for a while the U.S. had quite high rates and international markets mostly had very low interest rates, and then the U.S. economy was stronger. Neither one of those is necessarily the case anymore. U.S. rates have come down so much that the interest rate differential isn't quite as great, and the U.S. isn't necessarily recovering faster than some other countries. So we'll see what that means, but certainly there are some reasons that there could be a tailwind now behind some other currencies vis-a-vis the U.S. dollar, which would be a positive for international investors.
Hey, Brian, we do have a couple of questions that spurred, if you would like to take on some of those.
Please.
Gary and Susan says, when the world opens back up, wouldn't it be realistic to see a shift in tech?
Yes, I mean, I'd be interested in seeing that question, a little more clarified. There's probably a lot underneath the hood there, but I'll answer it one way. Is that, I absolutely think that as the world opens up, we're going to see a different world, right? So this is just my opinion. I don't think we're going back to the way things were. Right. I think that as with most things in life, we'll go back to some sort of hybrid, right? The pendulum starts in one spot, it swings, and then it doesn't come quite all the way back. And so, I think that will online shopping be even more prevalent than it was prior to the pandemic? Sure. Will online entertainment be more prevalent? Yes. So will maybe remote work, maybe a hybrid model where some people, maybe they work remotely. I don't know, maybe some of you out there want to like the Zoom meetings, right? Maybe some of you miss coming in the office. Maybe some of you like the Zoom meetings. Maybe some of you like doing a combination of both, right? So I think the world will evolve into a hybrid, and there will certainly be winners and losers. So we like technology. I mean, absolutely. It's the biggest sector weighting in the portfolio. It's just that we diversify beyond that too. And if you think about technology, there's the IT sector, your Microsoft, your Apple, your Intel, whatever, right? But there's also the use of technology in other industries. And I think that there's a lot of opportunity, let's say in like the financial sector, to incorporate technology to improve delivery to clients. There's a lot of talk around, if you think about like the materials and construction sector, right? Caterpillar now is making these massive, these trucks for mining, right? That don't have drivers. They're completely driven by computers and GPS. And then there's a recurring software subscription to help run the truck. And so, technology doesn't just mean technology companies. I think a lot of the benefit in the future will also be incorporating technology into industries that we think of as kind of old school or old world as well.
Let's see. Then Peter says, the market is high now. Will this continue? What investments are good buys for the next 6 months to a year?
So a couple things. First of all, we definitely don't, as a firm, make predictions, and we don't invest your money based on what we think is going to do best in the next 6 to 12 months, because, again, that's a really hard game to play. Not saying it's impossible. I, earlier in my career, worked as a bond trader and then as a portfolio manager. And we, my colleagues, and a bunch of well-known mutual fund managers I know would all try to time the markets, and it's really hard to get that right again and again. So we're definitely looking at building the portfolio based on what we think is going to do the best over the next 5, 10, 15 years, not what's going to do best on the next 6 to 12 months. So I think that that's important to consider. The second part of that, though, is, isn't the market a little bit expensive? I think it is probably fully valued depending on what metric you look at. So I don't believe that we're in a bubble or something like that, but I do think that there are parts of the market that are fully valued. But I think the key part of that sentence is parts of the market, right? So, when you look at some of the really big tech companies, or when you look at the S&P 500, some of those have extreme valuations, right? The Teslas of the world or something like that have very, very rich valuations. Not to say they can't keep going up, but they're not cheap, right? But when you look at other parts of the market that maybe have lagged, some of the, again, value companies have mostly sucked wind for the last several years, right? They're not very expensive by a lot of metrics. International stocks haven't done nearly as good as developed stocks, so they're relatively inexpensive by a lot of metrics. Again, emerging markets, depending on what country you look at. So I think it's about being selective and broadly diversifying so that, you still want some weighting in some of these things. You still want to own tech stocks. You still want to own Apple and Google. You still want to own the S&P 500, but broadening out to other parts of the market that maybe aren't as expensive, I think makes a heck of a lot of sense.
Ken would like to know, will Brexit be good or bad for UK stocks?
I'd be lying if I said I'm an expert on this subject, mostly because Brexit seems like it was so long ago, right? I mean, here's the problem is Brexit was the thing. If anybody remembers the market reaction overnight when Brexit unexpectedly passed, whatever it was, 5 years ago or whatever, seems like it's been going on forever. And it's kind of like this slow moving kind of like natural disaster. So I have to say that I don't pay a lot of attention to it. But my opinion would be, I don't see any way that it's a benefit for the UK. In fact, when they've polled voters, they said they didn't really know what they were voting for and they wish they had a do-over because most of them don't want to leave the Eurozone now that they think about it. It was more of a general, hey, we're not happy vote as opposed to, hey, we want to leave the EU. So I don't think it's going to be good. I mean, you've already seen the impact. So the financial sector in London as a percentage of the British economy is a really significant, more so than, let's say, like a New York in the United States or something. And then finance is a really, really key component of that economy. You've already seen a lot of finance jobs leaving London and a lot of other industries. So I don't think net it's going to be a good thing. But as always, that doesn't mean that there won't be winners and losers from it.
Next question is from David. There seems to be more than the usual number of experts predicting a significant market downturn. Why is this? Just as you take your drink of water.
Yeah, I think that I'll say two things. First of all, very, very few people in history, if we're talking about market prognosticators, have gotten famous for predicting the market's going to go up. Right? I mean, there were some books back in the 90s, hey, Dow 10 million and silly stuff like that. But very few people get famous for saying, hey, I think the market's going to rally 20%. When you think about like the famous trades and the famous prognosticators, it's always, hey, the world is coming to an end. There's going to be a disaster. The next Great Depression is coming or whatever it is, right? And they say it. And once every 10 or 15 years, they're right. And then they do victory laps for another 10 years while their performance is awful, right? Because in the long run, again, markets move higher. So I think there's a bias for a lot of prognosticators to do that because they can get famous and make a career of it. And second of all, I think that it sells. Fear sells, right? I've got the book out, Ignore the Hype. Like the press feeds on this stuff where it's like, hey, I'm going to make you afraid because then you're going to tune in, right? If I hit you with data, right? If I sat here and fear-mongered all day, you'd all be glued in. You'd stick around for an hour and a half as opposed to I'm hitting you with facts and it's not nearly as interesting, right? It's probably more useful to you, right? But it's not as much fun. It doesn't grab you viscerally the way fear does. So I think there's that. And then third of all, there's lots of clouds on the horizon, right? I mean, we're in a global pandemic. We just nearly had a revolution, right? I mean, there's all kinds of crazy stuff going on. It's easy to be afraid, and markets have done really well. It's easy to say they might fall. And again, they probably will fall at some point. It's just when and how much and which markets. Because again, I think the world is really broad. Different countries are coming out of COVID at different rates, experiencing it differently. Different economies are growing differently. Some companies are winners and losers, right? Zoom, right? How great has Zoom done because of COVID, right? I mean, they've had a pretty good pandemic versus other companies. Carnival Cruises, not so much. So I think that there'll be winners and losers like out of everything. Will there be another crash? Yes, absolutely. I 100%. As long as compliance isn't listening, I guarantee you there will be another crash. Just don't ask me when. But sometime in the next 50 years, there will be another crash, right? I mean, it's going to happen.
Paul would like to know, what effect will the change in administration have on the strength of the dollar versus other currencies?
Yeah, so this is my opinion, I want to be clear, and this is a little bit of speculation, right? It's not really what we hang our hat on as a firm. I think all else being equal, it will probably be a negative for the dollar. And here's why and it's actually not so much Biden in the White House. It's the results out of Georgia, which pushed the Senate towards Democrat control. Now with unified government, I think you're more likely to see more stimulus, which for the economy could be a good thing. But eventually those deficits, I think, will lead to potentially a weaker dollar. But that being said, that doesn't mean that I hate to say on the one hand, on the other hand, it's the famous economist thing, right? If you stimulate the economy with, let's say, $3 trillion, that could lead to a surge in economic growth temporarily, which could strengthen the dollar. But I think in the long run, what happens is you've got these large deficits. It eats away a little bit of productivity. All else being equal, you have to try to keep real interest rates a little bit lower, and that's probably a dollar negative.
All right, one more question for right now. When this is from Kevin, when might you recommend adding a crypto sector to the portfolios that Pure manages, or will you?
Yeah, that's a really good question. I don't want to say never, right? So I never say never to anything. Here's the challenge with cryptocurrencies. There's two challenges. One is, in the history of the United States, there's been something like 7,000 automakers, right? If back in 1910 I said, hey, autos are the wave of the future, let's buy an automaker, and there have been 7,000, I think there's one that has never gone bankrupt, right? And there's probably 4 in total right now or something like that. So just knowing that autos were the wave of the future, I mean, you could go and sit in Southern California traffic, you can tell the auto industry has done okay. Which company would you have bought at that point? That's different, right? So I think saying crypto and then going out, okay, even if cryptos are a thing, it's tough. Do you buy Bitcoin because it's the biggest now, or do you buy Ethernet or whatever that is? So there's these different, it's not Ethernet, is it? It's something like that, Ether, whatever. Right, you have to pick which one is going to be the winner. I think the second issue, even if, let's say, you go out and you buy a whole basket, is simply this is how we think about investing. When you invest, you take your dollars, you put them somewhere, and in exchange for that, you get a future stream of cash flows, right? If it's a stock, it's dividends. If it's a bond, it's interest, whatever, right? And the way that you value an investment is you say, all right, what future cash flows do I expect? How likely am I to get them? And then you apply a discount rate based on the risk, and you discount those back to net present value. It's finance 101. If you were running a company, it would be the same thing. Hey, I'm considering building a new factory. How much cash will it generate? What does it cost? What's the value of that project to me? All right. So the problem is cryptocurrencies don't provide any cash flow. It's the same as gold. They don't provide any cash flow, so you can't value them that way. And so what that means is that at this point, if you buy a cryptocurrency, you're saying, okay, what do I think it's going to be worth in the future? And you're relying on really what you think other people will say it's worth. Now, that could be a valid exercise, and I'm not saying they're not going to go higher. It's just a different exercise than how you value an investment. It's a little bit more of a trading or playing on somebody's emotions of what they're going to assign value to in the future. So at this point, given that they don't have cash flows, we probably would tend not to own them, but not to say never.
All right. Another one came in that I will ask you now, and I'll say there's a couple more that are, it's Ethereum. Thank you, Kevin.
Ethereum. Sorry, I was close. I had the first 4 letters.
David says, how big a deal is it that the XL pipeline was shut down?
I don't know. I mean, it probably depends on who you ask. I think that obviously if you're one of the companies that was going to make money from it, it's a pretty big deal. Right. For the energy sector, probably, not so much. I mean, as a whole, I think it speaks to more of a change in direction of the country. And I don't mean necessarily the political changeover, but more just kind of like what's important and sort of the environment and stuff like that becoming to the forefront a little bit. And the XL pipeline is interesting because it's not the only pipeline out there, and most people that have been involved with it, even running through their states, have signed off, and it kind of became a cause célèbre, and people jumped on it and wanted to shut it down for a while, and they've managed to do that. So I'm sure it'll hurt oil flows. The shale revolution has really been one of the great stories of the last 20 years, and has really changed America's position, whether it's vis-a-vis international security and dependence on the Middle East, global politics, as well as global energy markets. And, I don't think that's going to change. I mean, you might need to ship it a different way, and there are different price points at which some of those things are economical. But I don't see shale oil going away. And I get this question sometimes. I don't see oil and natural gas going away either. Most power plants in the United States are still run by natural gas, even despite wind and solar and stuff like that. Yes, we could go to electric cars, but I saw the statistic. I think cars are something in the order of 10 or 15% of total oil, right? So even if all the cars were electric, that still leaves 85% of oil, right? So planes, we haven't even talked about making planes renewable energy sources and stuff like that. So I don't think fossil fuels are going anywhere in the near term. I mean, maybe over 40, 50 years, but I'm not too worried about natural fossil fuels going away in the next decade or two.
All right. So if you do have more questions, just type them into the chat as Brian continues with his presentation, and we will get to those in a little bit. Thank you. Brian, it's all back to you.
Cool. So just to touch on a couple things with international, and this gets back to, I talked about the sector weights, and just to highlight here, let me see if I can draw this out. So this is the S&P 500 here on the left, and you can see information technology. And some of you can probably see it better than me, but it looks like it's about 26% or so of the S&P 500 is information technology. This is the MSCI EFA over here. So this is your main international index of developed countries. You can see information technology is about 9%. So again, this just gets back to the idea that sometimes if a sector is doing well, it's going to cause a market to do better. So looking under the hood can be valuable. You can see that here in this case, like financials, industrials have bigger weightings internationally than they do in the S&P 500. You know, if we look at one more thing with COVID, and this is another reason why I think global diversification makes some sense right now, is different countries are having different experiences. I mean, think about the fact that the virus originated in China, and yet China was the first country to come out of it, basically eased all restrictions and was living life pretty normally there for quite a stretch. I've heard they've had a couple more cases lately and stuff. And, you know, I think the data out of China is often open to question. But you know, if you look at maybe not official data, but just more private stuff around energy usage and travel and cell phones and these other measures, life was pretty much back to normal. So I think the idea is that different countries will recover from COVID and come out of COVID at different rates. Different countries will have different balance sheets depending on how much debt they've taken on. And that'll lead to different experiences for markets as well. Another question we get all the time is, why should I own bonds with rates so low? You know, and if you look here, this top line, this is the yield curve. And so the yield curve is you basically map out each year, 1, 2, 3, 4, 5, 6, 10, 20, 30, and then how much return you can get. And normally what you see is like this top line, it's pretty steep, right? And it makes sense. The longer you're going to lend somebody money, the more return you need. And you can see that in this last year that this curve, so the one at the top here is a year ago, and then the one at the bottom is now. And you can see how much it's come down, how far rates have fallen, right? And excuse me, it's actually 7 years ago. So that's 2013 versus 2020. You can see that short-term rates are still about where they were back then, but look at how much lower long-term rates are. This right here is one of the reasons that right now we don't recommend longer-term bonds, and why we're concentrated in shorter-term bonds. It's just because you don't get a lot of additional compensation for going out that long. The other thing I want to point out is if you look at this slide here, so some of you may own some high yield bonds or something like that. So for some clients, there's high yield or emerging market bonds, a little what we call a plus sleeve to provide a little bit of extra income to the bonds. When we use that, we use it only as a tiny sliver because fundamentally we believe that the bonds are there to support the portfolio. The bonds are there for the next 5, 10, 15 years of cash flow that you might need in retirement. And then the stocks are there to grow over long term, keep pace with inflation, meet legacy goals, et cetera. What happens is that when you buy more aggressive, higher returning bonds, those are the ones up here. You can see as you move from left to right here, there's more of a correlation with stocks. So what it means is that as you buy more aggressive bonds, they tend to move a little bit more similarly to the stock market. One of the functions of bonds is diversification. And so while we will occasionally sprinkle in some of these bonds, for the most part, we want to focus on those short, high quality bonds in order to provide that ballast to the portfolio. Another question we get, does inflation have to go higher, or doesn't inflation have to go higher? The answer, honestly, is probably not, but who knows, right? I mean, this chart looks at inflation, both CPI, which is the consumer price index, and then also core CPI, which takes out energy and food. And the standard joke is, yeah, this is great. Core CPI, which is what most economists look at and the Federal Reserve looks at. It's like, is the core. And it's like, oh, great, that's fine if you don't have to eat or, drive. Which, admittedly, the driving part may not be as much of an issue during COVID, but in general, you need to drive and eat and heat your home. The reason they take those out is because those prices tend to fluctuate a lot. And when they're trying to make monetary policy, they want to do it with some sort of stability. And those prices fluctuate so quickly, it will be hard to do. But what you see here, this is what scarred a lot of people, is back in here in the late 70s, early 80s, this double-digit inflation, right? And then even here through most of the 80s, you had, 4 or 5% inflation. More recently, with the exception of one brief spike, you've seen pretty low inflation and declining, right? And so inflation really hasn't been an issue for quite a while. Right now, we're running at about 1.5, 1.75%. In the short term, inflation is very unlikely to go higher as measured by the official numbers. And here's why. One of the biggest components of the consumer price index is a rent figure. They basically take the national rents and do an adjustment to it. If you think about some of the rent holidays, or whatever the right word is, but people that aren't able to pay rent right now because of COVID, and they're not being forced to pay rent because of various programs and stuff, that's keeping a lid on rents at the moment. So you're unlikely to see that component rise over the next 6-12 months probably, which then means CPI is not likely to go that much higher. Longer term, the question becomes, well, with all this money printing, doesn't inflation have to go higher? And it's like, not necessarily, because what matters is not just how many dollars there are, but how quickly they're being spent, right? So right now, although the supply of dollars has gone up, the rapidity with which they're being spent has gone down. So there's not as much money circulating. Longer term with inflation, my personal prediction is that inflation might creep a little bit higher. And just simply because I think the central bank, the Fed, has already said that they're willing to tolerate a little bit higher inflation. They're going to measure inflation now across market cycles instead of on a point-to-point basis. I think the government is going to urge a little bit higher inflation in order to kind of promote economic growth. And you're also, one of the things that we've seen with COVID is that supply chains, right? For the last 20, 30 years, the thing has been global supply chains. Let's source our products from here, 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 and then assemble them in a different spot, right? And all of a sudden what happens with COVID is you realize that as soon as that mobility is gone, you've got a real problem. So I think we're going to see some inshoring instead of offshoring, where you bring some production back into the United States. Maybe that's good for jobs and this and that. That's a whole different conversation. One of the impacts is that if you're no longer looking abroad for the lowest priced producer of everything, and you bring some more things back to being produced in the United States, that could raise prices a little bit. But that being said, how do investments do in different environments of inflation, right? And so you see 4 environments here. This is high and rising inflation. Well, I would say that we're not there because we don't have high inflation right now. High and falling inflation, I would also say we're not there because, again, we don't have high inflation. Low and falling inflation, well, we might be there, right? Or low and rise inflation. And so if we get low and falling inflation, so if inflation falls further, you can see that most asset classes do okay, right? You see bonds and cash and stuff with positive returns. You see stocks, different kinds of stocks with positive returns. And then you also see over here low and rising inflation. So if you get rising inflation from a low level, what you see is this is almost the best returns of any scenario, right? I mean, these are really strong returns. You see emerging market stocks have historically done well in that environment. Small companies, value stocks, high yield bonds, US stocks. So historically, rising inflation hasn't necessarily been a bad thing for investments. Now, if you get a spike where inflation all of a sudden shoots up to 10%, that's a whole nother story, but gradually rising inflation hasn't necessarily been a bad environment for investors. All right. That's the formal questions. Again, I just wanted to address some questions that we've been getting from clients that maybe are on some of your minds. Some other good questions have come in. Let me see what else is on everybody's minds here.
All right, so we have one other question that came in. How serious, this is from Jarrett, how serious is the impact of groups of day traders to the market?
And by groups of day traders, I think what he's probably referring to is where you get multiple people together to try and push the market in a direction. You know, I've heard that blamed for well, this is getting esoteric. Back in the spring when oil prices fell to negative levels, it was a technicality. It was energy futures, and it had to do with storage capacity. I've heard that blamed on a small group of traders. I think that in the short term, if you're looking at something like an Amazon or a Google, I think groups of day traders probably have minimal impact. When you think about that group of traders compared to the resources of, let's say, a large hedge fund or pension fund or Fidelity Investments or something like that, the resources just aren't there to move the market on these big investments or on treasury bonds or something. If you're talking about much smaller stocks or more niche-y parts of the market, yeah, I mean, I think that groups of people can get together and push the market in one direction or another for some smaller company. There are 2 important points here. One is that I'm talking over the short term, I think they can move those prices. In the long term, prices are going to come back to fundamentals, right? There's a famous example back in I think it was either the early 80s or late 70s, the Hunt brothers, famous billionaire brothers out of Texas that had made a fortune, tried to corner the silver market, and they drove the price of silver up from single digits to $50 an ounce. Were able to push the market where they wanted as they cornered the market. It eventually reverted to fundamentals, collapsed back down to where it had been, and those brothers went bankrupt. So you can move the market temporarily. You can't, for the most part, move it permanently. I think the second more important part is that it's illegal. You're not allowed to collude with other investors to push markets in a particular direction. That's not to say that it doesn't happen. I mean, lots of things that are illegal go on all the time, not just in the financial markets, but across society. But that being said, I think that if you see it happening too much, those are the kinds of things that the SEC is investigating. Regulators, for instance, those energy traders I talked about with the oil futures are currently under investigation by various authorities. So there are some gray areas in there, but at the core, if you're trying to manipulate markets, it is illegal. Let me pause there. That's enough.
Okay. William says, how can San Diego and other California cities sell bonds when they are billions of dollars in debt to their pension plans? Aren't they junk? Aren't those cities bankrupt?
Well, no, they're not bankrupt. First of all, for all the headlines about municipal bankruptcies, and I think we'll continue to see some because I think that there are municipalities that have made promises they can't keep. Municipal bankruptcies are pretty rare, right? It's like airplane crashes or whatever. Like the reason you hear about things is because they're not everyday occurrences. So when I can rattle off, hey, Puerto Rico, Detroit, Stockton, Vallejo, and you know that those are places that went bankrupt. I mean, I'm assuming most of you aren't municipal bond professionals. The fact that you've heard of these things means that by their very nature, they're pretty unusual. So for the most part, if you look at municipalities and municipal bonds, bankruptcies over time and defaults have been extremely unusual. I think that'll actually probably increase over time, but it's increasing from extremely low levels. So even a significant rise would still be pretty low. And I think municipal bonds done properly are a safe asset class. As far as specifically some of these, San Diego and some of these other municipalities, there's different things where it depends on what you're trying to fund. And sometimes there are dedicated bond issues that are designed to fund one particular project or to go into one pool of money, for lack of a better word, whereas maybe the pension is owed out of another. The other thing is that, people need to form their own credit on whether their own judgment on a credit basis on whether or not, let's say, San Diego or anybody else can pay back their obligations. So you should never, ever, ever, ever buy a municipal bond without doing research. You know what I mean? There are rating agencies that will rate these bonds on a scale of anywhere from triple C, or actually D, which is default, and triple C, all the way up through double C, single B, and so on up through triple A, right? Which is the highest. You don't want to rely on their judgment either. They're not always right. You want to go out and do your own independent research, right? And this is what I mean by that. If anybody's ever taken the toll road, I think it's the 73, the one that cuts through Orange County off of the 5. I knew they issued bonds. I think it's the San Joaquin Transportation District. I knew somebody that was a money manager at another shop when I was a bond portfolio manager that went out to that freeway and posted up in a lawn chair and spent a week there counting the cars that went by. Right, this was before he could get this off satellites, and he counted the cars that went by and then did the math on different times a day and stuff and how much revenue it was collecting in order to see if they could pay back their bonds. So unless you're doing that kind of research, you probably shouldn't buy the individual bonds. Go buy a mutual fund, a separately managed account, an ETF, something like that, where presumably the manager is buying them. Or if it's an index, they're buying so many of them that even if a few of them go under, just the weight of all the ones that aren't going under support that.
Man, talk about doing your own research.
Yeah.
Jerry says, please speak about the potentialities of financial resources being hacked.
Those are some big words in there. Potentialities. I like it. I think it's a risk. I think it's a risk. Forget financial risk. I think everything being hacked is a risk, right? I think every company, every individual in society, there's a lot of benefits that have come from the internet and technology and the interconnected world. And then there's the downside. And the downside is that people try to get your stuff. And so, as a firm, we put every safeguard in, speaking for ourselves, we put every safeguard we can in place on our end. We have IT people that focus on that. We keep the assets at third-party custodians to provide another layer of security. We require authentication, that kind of thing. Companies are doing everything that they can, but these things still happen. And I think that it's a risk.
Brian says, any potential tax changes that Pure is particularly keeping an eye on in respect to the new administration?
Yeah, that's a good question. And so for one thing, we do some of these with Big Al doing it and stuff like that, and Joe, and much more tax focused. So I would encourage you to, definitely the next time we host one of those to participate, because he's definitely the expert there, Al or Joe versus myself, where my background's more investments. But obviously, I'm heavily involved in the tax conversations as well. Yeah, I think that we're watching everything. I think some of the proposals, even though the likelihood of tax changes going through went up when Georgia went to the Democrats, right? but it's still 50-50, and there are still some conservative Democrats, and you still need to get everybody on board in order to pass everything. So I don't know if every proposal that you've heard floated is necessarily going to go through, given the way that Congress is composed right now. So that's one. The second thing is, I'm not sure anybody actually knows what the proposals are. There were lots of things floated, but there was never a comprehensive document or anything like that of, hey, this is my tax proposal coming out of the new administration so far, right? But yeah, I think that there are some of them. I mean, if something like the step up in basis at death was to pass for capital gains, I think that, or the elimination of that, I think that would be a big thing. I think that if the long-term capital gains rate was to go to 39.6%, which is one of the proposals for people in certain income brackets, that would be a significant impact and would certainly impact planning. And don't forget that even without any proposals going through, taxes are scheduled to go higher in 5 years. After 2025, the way the law is currently written, taxes are going higher. So even if the Biden administration doesn't pass anything, if no law passes, in 5 years, taxes go up. Right. So I think that's something that we're very aware of, which is why we spend so much time focusing on tax diversification. And look, and if you're asking for my opinion, whether it's under Biden or the next president or the president after that, I don't see any way taxes don't go higher. Right. I mean, we could talk about the deficit and some of the bills that we owe and stuff. I mean, we're at all-time low tax rates with a massive deficit, huge unfunded liabilities, and frankly, too, a country that's sliding towards I think probably on a secular basis, trying to do more for those that have been left behind maybe by economic growth in the last 3 or 4 decades. That's a combination that there's no way to solve for that without higher taxes, in my opinion. So yeah, I think taxes are going higher, and I think that's something that you want to start preparing for right now.
Okay, now we're back to your questions.
That's it. I'm done.
All right. Well, there you go.
I'm all done. I'm going home. No, I mean, so more seriously, first of all, I just want to end by saying, thank you all for taking the time to listen in today. I hope that you enjoyed this. If there are questions that you didn't get answered or that you think of afterwards, please email me or email your advisor. I'm happy to respond or to jump on a call or anything like that. Always happy to talk with you. Second of all, please stay healthy. I feel like, again, I'm not a doctor, but the sense I get is that we're not at the end of COVID, but maybe we're getting to the beginning of the end, to use kind of an analogy where the end is sort of starting to come in sight. And so, please stay healthy and safe until that time. We look forward to seeing you all in person again here at some point. We don't know exactly when that will be. For the moment, we're continuing to do everything remotely. I'm really happy that that's been such a seamless delivery method and that we've been able to continue to do the same level of financial planning, the same level of tax planning, the same level of investing. There's been absolutely no change in the service delivery or what we do on a day-to-day basis. But we're continuing to run our offices with a skeleton staff, with most of our employees working from home, just to keep everybody safe. But we look forward to seeing you all again. And I know it's been a volatile and crazy year. I just want to urge you all to the degree that you can, probably best to turn off the news, but if you have to watch it, try to separate what you're seeing in the headlines from your finances, right? Because there are some crazy stories going on out there. Talk of civil wars and this and that. And I think at the end of the day, everybody has opinions on the direction of the country and the world. But it's important to always bring it back to, yes, but what does that mean for your financial plan? What does that mean for your finances, right? And that's the reason why multiple times a year we're running your cash flows. We're stress testing. We're running different scenarios. We own a variety of asset classes in there because we want to be prepared for almost any eventuality. So if you're concerned about things, reach out to your advisor, have a conversation. If you want to talk to me, I'm happy to do it. And then the bottom line again is thank you all for your trust in Pure. Look forward to seeing you all again. Stay healthy and thank you very much.